Two investors, two screens, one shared starting line. Alex and Sarah sat at their desks on the same Monday morning, each staring at a balance of $10,000. The numbers on their monitors were identical, a perfect mirror image of potential waiting to be deployed. They were equals in every sense, standing on the same threshold of the financial markets with the exact same amount of capital to command. But the similarity ended the moment they clicked the buy button. Alex leaned forward, his finger hovering over a high-yield fund, calculating the immediate cash flow he could extract from the market. Across town, Sarah opened a different tab, her eyes scanning the long-term growth metrics. Neither knew it yet, but they were about to embark on two entirely different trajectories. One was chasing immediate gratification, while the other was planting seeds. The screen blinked, the order was confirmed, and the divergence began. They started as equals, but their financial destinies were already moving in opposite directions. Alex clicked the mouse, locking his capital into a high-dividend ETF. He watched the screen, his mind already calculating the quarterly cash payouts he expected to see hit his account. To him, the market was a machine meant to produce immediate, tangible returns. He wanted the money to move from the fund into his pocket. He did not look for growth. He looked for the yield percentage. Meanwhile, Sarah navigated to a different section of the platform. She selected the ESG Market Index Fund, 00850. Her screen showed no promise of cash payouts. Instead, she focused on the underlying assets, the companies that were reinvesting their own profits into research and expansion. While Alex waited for a notification of a deposit, Sarah watched the share count in her portfolio. One investor was building a pipeline for cash, while the other was building a foundation for growth. 5 years vanished into the rhythm of the market. For Alex, the routine became a ritual. Every 3 months, his phone chimed with a notification from his brokerage app. He would open the screen, see the cash deposit, and feel the immediate, tangible satisfaction of a return on his capital. It was predictable, reliable, and frequent. He treated these payouts as a validation of his choice, a steady stream of money. Across the digital divide, Sarah lived in a different reality. Her account remained silent. Instead, she watched the share count in her portfolio creep upward, decimal by decimal. Every dividend was silently funneled back. She did not see money in her pocket, but she saw her ownership stake in the market expanding. Both felt they were winning, completely unaware of the structural reality building beneath the surface. Alex tapped his brokerage app, ready to log another quarterly dividend. He expected to see a higher total balance, a reflection of 5 years of consistent payouts. The screen loaded. He blinked, then refreshed the page. The total portfolio value sat at $10,040. He stared at the number. He had received thousands in cash over the years, yet his principal remained essentially frozen. He scrolled through the transaction history, only to realize the fund's share price had dropped by the exact amount of every dividend. The money he thought he was earning was simply his own capital being returned to him. A cold tension tightened in his chest. The line was flat, a horizontal pulse that never climbed. He had been running on a treadmill, sweating to stay in the exact same place. The engine of his wealth was not generating value. It was merely recycling his initial deposit. He was watching his capital slowly erode. Sarah opened her own brokerage app, her fingers steady as she navigated to her portfolio summary. The screen displayed a figure that had climbed well beyond her initial $10,000 contribution. Her eyes traced the performance chart, a steady, upward slope that defied the stagnation Alex was currently experiencing. She saw the companies she held, giants like TSMC, and noted how they had aggressively poured their profits back into new factories and research. This was not just a number on a screen. It was the physical expansion of her ownership. She watched the value of her holdings surge, the result of 5 years of compounding. While Alex had been busy collecting cash, Sarah had been building an engine. Her wealth had not merely shifted from one pocket to another, it had grown, fueled by the structural expansion of the economy. She compared her current balance to her starting principal and saw the difference clearly. Her capital was working, scaling, and multiplying. She closed the app, the data confirming that her choice to prioritize growth had fundamentally altered her trajectory. She was no longer just an investor. She was a builder. Alex zoomed in on the fund's price history, looking for the missing growth. He aligned the dates of the cash payouts with the dips in the share price. The pattern was mechanical and absolute. Every time the fund issued a dividend, the net asset value dropped by the exact same amount. He pulled out a calculator, punching in the numbers from the last 3 years. The math confirmed the trap. The fund was not generating profit. It was simply liquidating his own holdings and returning them to him as cash. He had been paying himself with his own money, a cycle that felt like running on a treadmill. To break even, the fund had to fight to recover that lost price every single quarter. It was a game of chasing one's own tail, a constant struggle to reclaim ground that had been intentionally surrendered. He realized the high yield was a mirage, leaving him with the same starting capital after years of supposed progress. The divide between their portfolios was not just luck, it was a fundamental difference in architecture. Alex held a collection of mature, slow-growth companies, traditional giants that had long ago exhausted their capacity for innovation. These were value traps, stagnant entities that offered the illusion of safety through dividends while their underlying business models decayed. Every market cycle exposed their weakness. When the economy surged, these companies remained tethered to the past, unable to capture the explosive growth of the new era. Sarah, by contrast, had aligned her capital with structural expansion. Her holdings were built on high-efficiency leaders that prioritized R&D over immediate payouts. When the market entered a bull run, her portfolio did not just rise, it scaled. She captured the momentum of innovators that were actively reshaping the economy. While Alex spent his time calculating yields from declining industries, Sarah watched her principal compound through the sheer force of corporate progress. She understood that a portfolio is either an engine for growth or a warehouse for decaying assets. By betting on the structural expansion of the market, she had ensured her wealth was not merely preserved, but aggressively multiplied. The cost of Alex's strategy was now visible in the numbers. He had traded his future potential for the temporary comfort of a quarterly check, while Sarah had secured a position in the companies that would define the next decade. The math is not a matter of opinion. It is a cold, relentless calculation of opportunity cost. If you are in your accumulation phase, your primary objective is the expansion of your principal. Every dollar you extract as a dividend today is a dollar that loses its ability to double or triple over the next decade. This is the hidden tax on your future. Consider the trajectory of a single dollar. Left inside a growth engine, it compounds, feeding into new factories, new research, and new market dominance. Removed as a payout, that same dollar ceases to work. It becomes stagnant cash, a finished product that can no longer scale. You are essentially starving your future self to fund a minor temporary convenience in the present. The choice is binary. You either build the engine, or you settle for the scraps it leaves behind. Look at your current portfolio. Do not look at the ticker symbols or the account balance. Look at the intent behind the assets. Is your money currently a collection of stagnant cash flow generators? Or is it a growth engine designed to scale? This is the moment of decision. You have to ask yourself if you are a dividend hunter, someone who starves their future self for a few $1,000s today, or a wealth builder, someone who understands the power of patience. The choice you make right now, in this very moment, determines your trajectory. Will you be struggling to maintain your lifestyle in retirement, tethered to the diminishing returns of mature, slow-growth industries? Or will you be living off the massive, compounded wealth you built during your prime years? The math has spoken. The evidence is clear. You cannot build a future by harvesting the seeds before they have a chance to grow. Stop chasing the yield. Stop looking for the quick payout. Start building the future. The accumulation phase is your only chance to set the foundation for decades of freedom. Do not waste it on the illusion of safety. Take control of your capital, align it with the innovators and the high-efficiency giants of the economy, and let the compounding do the work for you. The path is open, the strategy is proven. Now, it is time to act. Stop chasing the yield and start building the future.